Hello everyone, this is Sebastien McMahon from IA Financial Group and I'm back with the weekly review for the week ending April 21st, 2023. So let's start with a look at this week's markets at the close on Thursday. So a relatively positive picture here for bonds, stocks when you bring everything back in Canadian dollars because oil was down, the CAD was lower. That means that it boosts the returns for foreign assets, meaning that pretty much everything was positive in CAD here for bonds and for equities. Price of gold was volatile on the week, but ended up with a slight positive on Thursday. So still a positive picture here year to date than to be in the black pretty much everywhere. So what I thought I'd do this week is to focus on our current views and our current positioning to make sure everyone understands where we stand. Because when we discuss the economic data, of course the picture is getting blurry. Of course we're seeing signs that of economic weakness ahead of us. But as asset allocators, whether the environment is positive, is negative, there's always a trade somewhere. There's always an asset class that is interesting that we can go to. So we're never, hiding under our desk or holding 50% cash in portfolios. That's not how it works. And I want to make sure that everyone understands the message here. So the spotlight on our current views. This is from the latest monthly that we published in early April. It's available on social media with your IA representatives. So if you can find it, you can always ask your IA rep. But the positioning is pretty simple here. We tend to be overweight money market, overweight fixed income, and underweight equities. So let's say that we have a typical balanced portfolio, and I'm not talking about a specific fund of ours in particular, just a prototype. Let's say you have 50% equities, 45% fixed income, and 5% cash. Let's say this is the target asset mix. Well, the picture here would translate into us being underweight about 2 to 3% equities, so 47-48% equities instead of 50, so not 0% equities, not 10%, not 20, no, 47-48, and overweight on the money market of about 2%, maybe leading us from 5% to 7%. And you always want to have some money market now because the money market gives us a very interesting yield of about 4.5% in Canada, 5% in the US, because the leading rate has risen to the highest level since 2007. So this is a positive. And also you want to have cash on hand to be able to benefit from opportunities when they arise. And we have a small overweight in fixed income, which here would be about 1%. So instead of being 50 equities, we would be at about 47. Instead of being at 5% cash, we'd be at about 7. And instead of being at 45% fixed income, we'd be at 46. This is pretty much how we're positioned, relative to the various benchmarks in all of our funds. So we're not, overly defensive. The idea is to pick your spots, to pick the risks that you want to expose the clients to, and do it in a responsible way. This is the message here. So underweight in equities, as you can see, it's all in the US, and we have reasons to believe that the US stock market is expensive. The risks reward ratio is not as interesting as other regional markets. So this explains why we're underweight in the US. We're neutral Canada, neutral international, neutral emerging markets. So it's all about the US story. In the fixed income, we tend to be overweight government bonds, sovereign bonds. Their default risks are very low. We're at 0 for Canada and the US, we would say. IG corporate bonds, so investment grade, the high quality corps, we tend to have a slight overweight, and we tend to have a stronger underweight on high yield, which is consistent with our underweight in US equities. So if you're borrowing, if you're lending money to a low quality balance sheet corporation in the US, well, you're exposing yourself to some risks which are similar or consistent with the risks that we typically see in equities, so they go hand in hand. We're bullish on oil long term. There was an underinvestment in oil in oil production and exploration during the COVID period. And now pretty much every forecast out there from the experts, and I'm not an expert on oil, but I read all of the experts, they pretty much all point towards higher oil prices within the next few years. So we have a positive view there. Gold will remain steady now. The Canadian dollar will remain steady now. And the US dollar we still view as being, positive over the next few months as the whole bear market story in the US gets resolved. So let's go maybe at a few charts here to support these points. First one, we see interesting opportunities in Canada in equities. So the Canadian stock market on the right and the US stock market on the left. So these charts here, they're forward PE percentile. So forward PE means forward price earnings. So this is the price relative to what's expected from earnings growth by businesses, and we have a history of that. And on the left, the US, well, you see the evolution of the percentiles through time. And right now, the message here is that the US is trading at the 75th percentile for forward price earning, meaning that if you look at all of the history since the early 1990s, well, 25% of the time only, the US stock market was trading at a higher premium than right now. And 75% of the time, it was trading at a cheaper premium than right now. So the US stock market is relatively cheap on a historical basis. And on the right, for the TSX, it's exactly the opposite. We're at about 25th percentile here, meaning that 75% of the history of the last 20 some years, the stock market in Canada was trading at a higher premium than now, and 25% only at a lower premium. So it's relatively cheap on a historical basis. So that's why we see a better margin of safety, let's say in Canada, better opportunities to be invested in Canada, or at least a better risk-reward ratio in Canada. So that explains why we're underweight the US and neutral elsewhere. For the loonie here, oil prices in blue, Canadian dollar in gray here. Well, there tends to be a strong correlation between the price of oil and the Canadian dollar. The Canadian dollar also tends to be very correlated to the global risk appetite in markets. So the correlation, you've seen a divergence since the pandemic started here, but we do expect that Canadian economy will flow through the coming economic turmoil in good shape. We see the price of oil as maybe being volatile in the short run, but being steady over the long run. And when risk appetite comes back to the market, that should support the loonie. The price of oil will also support the loonie. So in the long run, we still think the Canadian dollar has some good upside here. So when we feel that it's time, expect us in our money market to be long Canadian dollar, short the US dollar, and make sure that we get the exposure that we want from that. So benefiting from the Canadian dollar appreciating. Looking at bonds now, and I use the US data here because I want to use the speculative positions on the right of this chart, of these charts here. But on the left, the 10-year rate, as you can see, over the past decade, I would say, interest rates were so low that you didn't get a good, coupon return from holding bonds. But now we see rates that are at the highest level in about 15 years. So it's very interesting now to hold bonds as part of a portfolio, a balanced portfolio, mostly for the coupon return that you can get. So 60-40 is back again. And since rates are higher, if we do see an economic slowdown, then we could see capital gains from those bonds because interest rates are higher. So there's more potential for falling rates in an economic slowdown. So that's positive. And on the right, the speculative positions. So this is hedging positions from hedge funds. So there's a lot of things here, but the message is that the market tends to be generally short or underexposed, or have short positions here on the 10-year treasuries. And if we start to see an upward move in the price of treasuries, meaning that rates fall quickly because of an economic shock or something like that, well, it could go pretty quickly to cover all of these positions. So you want to be exposed to bonds right now for multiple reasons, and there's just a few here. So moral of the story here is that yes, we do have a more conservative positioning. Conservative means a few percentage underweight equities, a few percentage overweight fixed income and money markets. So it's not like it's 35% cash, no equities, and we're just waiting for the world to end. Even though we have a negative economic outlook, as asset allocators, I'll repeat it, good times, bad times, volatile times, it's a relative game, and there's always an asset class somewhere that offers interesting opportunities. So it's just, we're just rotating the money around to give our clients the best exposure to the risk premiums out there. So I just wanted to make sure that this is understood. So what to watch next week? GDP growth in Canada. Last reading was 3% year over year in January. So let's see where we end up. And in the US, Conference Board Consumer Confidence Index should be going sideways, but at relatively low levels for consumer confidence. And we'll have the core PCE inflation, which is the measure followed by the Fed, 0.3% month over month in March, sideways, a bit above comfort levels of 0.1, 0.2%, but still not too high. So maybe we could have some good news from inflation next week. So that wraps it up for the week. ia.ca/economy. Everything you need, you'll find there. So I'll be back again next week.